morning and welcome to the show today. I think we've got a good one lined up for you. Today on the Wealth Guardian Show, we're going to take a look at the bullish case for the stock market for 2017. And in the first half of the show, what I'm going to do is I'm going to look at the fundamental analyst and what they're saying about the fundamental condition of the market and their bullish projections. And then the second half of the show, we're going to take a look at technical analysts and what they say is setting up to make 2017 a strong technical year for the market. Before we get going, though, I always want to take just a moment to say thank you very much to all of our service men and women in the armed forces. Thank you for what you do for us and your sacrifices that you make. All right, let's start with Professor Jeremy Siegel. He's probably one of the more bullish fundamental analysts, and has been for quite a while, and obviously he's been spot on. Dr. Siegel is world-renowned known. He's a professor of finance at the Wharton School, which is one of the most prestigious business schools in the world, actually. But bottom line is he is projecting a 22,000 number on the Dow for 2017. And he thinks it's justified if we can get a lot of the Trump agenda in place. And let's just kind of quickly review what that agenda is. Lower corporate taxes. We have the highest corporate tax structure in the world at 35%. He wants to get that down to something around 15%. Regulations. We're drowning in regulations and red tape and so forth and so on. I mean, it's just awful what we have to put up with in the business world. Obviously, healthcare. We've got to do something about this failing Obamacare. It helps very, very few people, and prices on insurance and medical costs are just escalating beyond control. But there is always that one fly in the ointment that is what to do about pre-existing conditions. That's a nightmare for insurance companies to be able to cover. Then we also have the border situation. Build the wall, get control of our borders. That needs to be put in place, and then also. In the Trump agenda, we have to get tax reform on our personal taxes as well. I think we've got 7 different brackets right now. Trump wants to go down to 3, and with the highest marginal rate at about 33%. So Professor Siegel is quite bullish on the market. If we get to 22,000 this year, that's another 5% from where we are right now. Given this market's run, I think 5% would be a nice return for 2017. Okay, let's take a look at Bill Miller. Now, Bill Miller, I don't know if you know that name or not. Most of us in our line of business know his name. He was the 5-star mutual fund manager for years with Legg Mason, and I would put him right up there with Peter Lynch in terms of his abilities to manage money. So one of his quips in the article that I was reading is he's basically was being interviewed, and he says Warren Buffett once remarked that the only value of stock forecasters was to make fortune tellers look good. So despite all that, he said that he thinks that this long-running bull market in equities, it all started in March of 2009. The market grew from a high of 600 in the S&P to recently it's been as high as 2,400. And he thinks that it still has some room to go. Again, he likes to quote Sir John Templeton. And this is a famous quote that Sir John made. He said, "Bull markets are born in pessimism. They grow in skepticism. They mature in optimism, and then they die in euphoria." And we haven't seen euphoria phase yet. I think we're definitely in the mature optimism stage of this market. But Bill goes on to say that he thinks the market can eke out another 5%. He too is looking at Dow 22,000. Now he says one thing that could be a stumbling block is that bonds. He said the situation with bonds, though is far different, had been more ominous. The great bond bull market, which began in October 1981, looks to have ended in July. Remember, I've commented on that on a couple of the radio shows we've done just in the past month or so. I think the bond market hit its peak right after Brexit. Treasuries began that October 1981 bull market phase at 15.83%. That's the highest yield in U.S. history. And it ended last July with Treasuries hitting its lowest point in history of 1.35%. Now, he's not saying that he thinks interest rates are going to go back to 15%, but they're so low now that even if they move back to what we consider a normalized rate of about 5 or 6%, that's for a bond. That's a big hit to bond prices, and it could have a major stumbling block on the equity market. But again, he predicates all of his forecasting techniques on the Trump administration getting most of their agenda passed. He says the stock market is not as cheap as it used to be, but it's also not as expensive as it's likely to get. That's the euphoria phase of the market he's talking about. So again, he says this year's rate of return probably somewhere in the 5 to 7% area, and that is also both the sum of earnings and dividend growth on stocks. All right, if you just joined us, you're listening to the Wealth Guardian Show, and we're talking about the bullish case for the market. I want to also review a case study that seems to be pretty popular. For those of you who may have not heard about this, I call this just an all everything account. It's a savings account. It's an account that grows your cash. It is an account that if you never touch it, it'll pass to your beneficiaries tax free. It's an account that you can use for long-term care and home health care. You can take withdrawals from it if you need to spend some money, and it's completely 100% liquid. You can get every dime of your deposit out of it if you decide you don't want the account. Technically, it's called a modified endowment contract. It is built on a chassis of an index universal life policy. And thankfully to the Pension Protection Act of 2006, that gave us the ability to have these types of modified endowment contracts give us those living benefits of long-term care and home health care. So let me give you just a quick example of what this has done for one of my clients. On February of 2014, she deposited $180,000 into the account. And by the way, this account will give you a 12% bonus day one. So immediately, it's 12% higher. Now, that money had previously been sitting in a bank making virtually nothing. So she made 12% overnight from nothing. That's pretty good. But more importantly, that $180,000 was leveraged immediately to $298,000, almost $300,000 for her as a death benefit, tax-free, or she can use it for long-term care and home health care. Now, she needs it for home health care. That'll give her $4,966 tax-free per month for home health. If she has to go into a facility, that'll give her $8,200 a month tax-free for that. Now, here's the really cool part. In February of this year, her $180,000 cash value had grown to $241,000. That's $61,000 in 3 years. That's a 30% return in 3 years. But also, more importantly, her death benefit had grown to $420,000, which means if she got hit by that proverbial bus today, her beneficiaries would get tax-free $420,000. Even more importantly, if she needs it for long-term care or home health care, she can get $11,666 a month for long-term care or $7,133 a month for home health care. Now, that's pretty daggum decent, I say. So if you're interested in talking about something like that, if you got money sitting in the bank that's earning next to nothing and you want to leverage it up, it's just like literally like taking money out of your right pocket and putting it in your left pocket. Give us a call at the office. That's 336-391-3409. 336-391-3409. Well, like I said, when we come back from the break, I'm going to get into the technical side of this bull market, and I'm going to talk just quickly about Tom Lee. He's been a long-term bull. Tom is the global advisor and head research of FundStart, and he has been a bull since 2009 as well. He too believes that it's not over. That 2017, he thinks you can get another 7% or more this year. But again, he is saying, provided that a lot of the Trump administration's policies get enacted, because the price of the market has that built into it already. What's important, according to Tom Lee, is for some of this money to be repatriated that corporations have overseas. If they bring it back now, they're going to be paying 35+% in taxes on it. If Trump can get his way, then they're only going to pay a fraction of that. That way they can put that money back into work, building capital infrastructure, hiring people, so on and so forth. And that would put a big lift into the economy. All right, so we'll be back in just a minute, and we'll take a look at the technical side of the bull market coming up with more Wealth Guardians. See you in a minute. Hey, welcome back into the Wealth Guardian Show. Today we're taking a look at the bullish case for the stock market for 2017. And if you were with me the first half of the show, we went over some of the fundamental analysts who are bullish on the market, such as not Ralph Hockenport, but Bill Miller, Tom Lee, and Professor Jeremy Siegel. On this flip side of the show, I'm really interested in the technical basis of the market, and I want to look at some technicians and what they have to say about this market and why they think their technical opinion is a bullish case. For those of you who don't know what technical analysis is, it really is basically you've heard the phrase history repeats itself, right? So basically what we're saying with technical analysis is that we know markets go in cycles. And if we can look at price patterns and identify certain trends and patterns and so forth, then we can't necessarily predict with 100% accuracy when and where the market's going to go. But if we take that view that markets are cyclical and history tends to repeat itself, and we can identify some of those markers, then we can put into the stock pattern potential targets and so forth. And there's certainly some patterns that shape up to be what we call bullish, and certain patterns that turn out to be bearish. Right now, the bullish case, the technical bullish case for the market is many. Almost all indexes are above their 200, 100-day, and 50-day moving average. That's very good. We had a Dow theory bullish confirmation last year. That's basically when the Dow Industrial Average and the Dow Transportation Average hit highs at pretty close to the same time. That confirms the uptrend. So the technical side is still strong. When would I be concerned? Well, I like to look at the moving averages. You start to get concerned when we have a market that goes below the 50-day moving average. You really start to get concerned when it goes below the 200-day moving average. So, in fact, that would be an out-and-out sell signal if you use my 50-50 strategy that Dr. Charles Schaap has champions with great success. So let's take a look at Louise Yamada. She has been, in my opinion, one of the better technical forecasters for years. I've followed her work, golly, I guess ever since I was with Merrill Lynch back in the early 90s. She has her own firm, Louise Yamada Technical Research. And bottom line is she thinks that the uptrend is still here to stay. It is an aging bull market, as she calls it. And she thinks since we've had such a big move off of the Trump election, the market needs to digest some of these gains before it moves higher in 2017. One of the things she looks at is also the Russell 2000, which is basically the index of small company stocks. She said that broke out in November, obliterating a topping process around the 1300 level. That's very bullish on a technical basis. Again, she thinks that the market's in 17, that she thinks the Dow could probably get somewhere around 22,000, S&P 500 somewhere around the 2,500 area, and it has been tracing out kind of a basing pattern since about 2013 between around 17,000 on the low side. I'm talking about the Dow, and then about somewhere around 18,000 on the high side. When it breaks out above that, which it has, by the way, that is an indication of a continuation move, a strong continuation move higher. So that's Louise Yamada's technical case for the market. Pretty simple stuff there. All right. If you just joined us, again, we're looking at the bullish case for 2017 for the stock market. I'm looking at technical analysis in this part of our analysis. And before we get to Ralph Acampora, I want to kind of highlight another program that we offer in our practice. And this one, I gave you in the first part of the show an idea for some of that money that's sitting in the bank doing nothing. That's after-tax money. You've already paid tax on it. Well, what do you do with your IRA money or your 401k rollover? This has been a fabulous program for our clients. It uses an indexing strategy that Professor Bob Shiller created and won the Nobel Prize for, and it's called the Cape-Shiller Index. Barclays Bank manages this index. It stands for Cyclically Adjusted Price-Earnings Ratio. And bottom line is, without making it too complicated, what happens in the bank at Barclays every month? They take a look at 1,000 different stocks in all of our economic sectors and use Dr. Shiller's algorithms and formulas to boil 1,000 stocks down to 100 stocks that are built on value and price momentum. So they're looking for the 100 most undervalued stocks of the 1,000, but at the same time, the price of the stock has to be going up. So you've got some value and you've got some momentum strategy built into this program. This, by the way, the Shiller Index, you really ought to take a look at it, because going back to 2005, it has absolutely outperformed the S&P 500 hands down. And I want you to understand, the S&P 500 itself outperforms consistently over 94% of all mutual funds and money managers out there. So the S&P 500 is not an easy thing to beat over time, but this Shiller Index has done it by a wide margin. So last year, just about right now, 1 year ago, I've got a client who retired, and she rolled over $600,000 in her 401k. And immediately, this program gave her a 10% bonus, so her account was $60,000 higher. And it's in the Shiller Index. Well, this week, her account value hit $790,000. That's 1 year. That is almost $200,000 gain on $600,000. That is almost a 33% return in 1 year. Now, granted, 10% of that return was a bonus. But still, off of the Shiller Index alone, we've had over 20% in a year's time. And that's just not one cherry-pick case, folks. I've got story after story after story of clients who've had that kind of success with this program. If you're interested in looking at this for some of your IRA or 401k money, call us at numbers 336-391-3409. 336-391-3409. And of course, I have to say, past performance is no guarantee of the future. Let's hope these bullish analysts that we're talking about today are right, and we continue to get upside performance. If we do, that Shiller Index will continue to perform magnificently. And also, by the way, because it's got such a value component to the strategy, when the market does go down, it doesn't go down with the market. It is less volatile on the downside than the market is. So that's what you want in a good investment. Higher upside potential and less downside potential. All righty. Let's move on. Let's take a look at Ralph Acampora. Now, Ralph is another one that I have looked at or followed since my Merrill Lynch days. Ralph was originally with Prudential way back in the day, and now he is the director of tactical investments at Altera Capital Partners. And basically what he's saying is, he says the rally we're seeing now is a Reagan-like rally. And what he's talking about here is the Dow's climb during the Reagan administration and its current rally under the Donald Trump administration is very essentially going through the same techniques together. He said, if you recall, Reagan had a honeymoon period too. So from the election day of November of 1980 until April 1981, in just a 6-month period, the Dow gained 15%. That was his honeymoon period. And as we know now, the Trump administration, since his election day till now, the market's up about 14%. Although he's had a rough couple weeks, he's still had a nice honeymoon period. Now, after Reagan's honeymoon period, the Dow dropped by as much as 25% through the rest of 1981. And Acampora said that happened because it took longer than expected for Reagan to get his policies implemented. This is starting to sound familiar, doesn't it? It's starting to sound like, Trump is being fought tooth and nail by every corner, it seems, to get his policies in place as well. Now, Acampora says, to go on, that does not diminish the fact that after that 25% bottom happened in August of 1982, that was the beginning of the next major secular bull market that lasted 18 years. Now, recall the 80s and the 90s, folks. That was based on Reagan's policy changes. So he feels like that, again, he's targeting a Dow 22,000 for this year, about another 5-6% higher than we are now. But again, he thinks that, if Trump can get his policies in place, that's going to set the stage for even further advances. So what have we seen from the fundamentals and from the tech people? I think we're seeing the same kinds of thinking here. The Trump policies, the tax cuts, the repatriation of corporate cash, corporate tax cuts, repeal and replace Obamacare, the wall. Those things, maybe not all of them, but those things need to somehow come to fruition for this economy to heal and get better and start another secular bull market. Boy, wouldn't that be incredible if that could happen, if we could start another 18-year run on the bullish side like we did with the Reagan administration. Wow. I'm looking forward to that. Let's hope it happens. All right, folks. Love being here with you today. This is the Wealth Guardian Show, and we'll see you next week.